Aloha, this is Paul Brewbaker of TZ Economics, Kailua, Hawaii, with part three of a three-part post-pandemic Hawaii economy discussion. Uh, this part will focus on resilience and long-term growth. And let's get right to the slides. If you'd like a copy of the slides, you can email me at Paul Brewbaker, Paul Brewbaker, Brewbaker, Paul Brewbaker, no dots, at TZ Economics, Tango Zulu Economics, no dots, tzeconomics.com, Paul Brewbaker at tzeconomics.com. I'd like to acknowledge the support of the of CFA Hawaii in preparing some of these materials, as well as many other clients through the year. This has been a presentation. It's a long version of something I shared at the Hawaii Economic Association annual conference in October 2024. So props to them. Mahalos for the opportunity to get into some of the new material from the Fed's Jackson Hole meeting in August on the beverage curve and tight labor market implications. That was part two. And this part will be followed by a concluding part, which has to do with the legacy of remote work and links to some housing economics issues primarily. But today we're talking about post-pandemic resilience, and actually resilience in the broader context, resilience management, a new concept that has been introduced this year by Marcus Brunnermeier at the American Finance Association and ASSA meetings in January of this year. And we'll apply it as usual to Hawaii data so you can get a feel for what those data look like. So let's talk about the long run for Hawaii, a couple different indicators to give you a feel for what that looks like, and then we'll focus on this issue of resilience that comes up in the post-pandemic context, but is also something about which Princeton professor Brunnermeier has expressed concern as a legacy of the Great Recession of December 2007 through June of 2009. So here's a couple illustrations of the long run for Hawaii. These are statewide or territory-wide before statehood. Total contracting receipts, so total construction revenues essentially, adjusted for construction cost inflation, where I have an index with using CPI and the national proxy, where we don't have Hawaii data, going back to the late 1930s. And so these are constant dollar construction receipts or construction spending data. And you can see the curvature, the long run curvature, which on a log scale means that the growth of construction has been decelerating over the last century. So a period of much more rapid growth in the first half or middle two quarters of the 20th century, continuing with the spike associated with World War II activity, of course, the early statehood, catch a wave period, and then a couple of famous bubbles, the Japan bubble, the subprime bubble, and a period that I call new urbanism that was associated with lots of architects talking about live, work, play in the 20 teens, a cycle or subcycle, which is now concluded as we move in and through the 2020s post-pandemic. So that flattening, the diminution of trend growth that you can just observe here is consistent with the deceleration and actual decrease in resident population we now see statewide because of Oahu, but in addition, since the wildfires and possibly since the pandemic in Maui County as well. You see the same kind of pattern in tourism performance. So these are constant dollar tourism receipts, where I've used either the new tourism price index that the state has published, or prior to its availability, versions of the consumer price index. So deflated, constant dollar, 2023 billions of 2023 dollars, showing the rapid growth of tourism as now the dominant export. That same arc of rapid growth in the 20th century, ending the 20th century and entering the 21st century with basically no growth, either on the investment side of the economy, cycles around trend, but no obvious trend other than sideways, and a definitive sideways trend in Hawaii's principal export, about now maybe 15 to 20% of GDP, back at its peak, and it's still the peak to this day, 1989. So I want to decompose this version of Hawaii GDP into a trend component, which you saw here, and then extract the long-term super cycle, as well as a residual component, which it's actually moving around zero there. So it's a very small residual. So you can pretty much pick up everything that's happening with the trend and the cycle component. And here are the components segregated, so you can see each of them individually. So the three black, the dashed lines, and the zigzaggy line and the residual there, which are in log points, not real GDP. You can literally add them up and reconstruct the GDP data in the upper left in blue, for this interval post demobilization and pre-pandemic. Now, another way of this is sort of an arbitrary decomposition, in the sense it's not arbitrary, but you have to make some judgment calls. And here I've just taken the non-cyclical component. So you extract the cycle with a bandpass filter, and then you estimate the trend, and that's where the judgment comes in. So this is just a second order polynomial, with, you could see, a fairly narrow residual component. But closer examination suggests that in the 21st century, we've entered this window where things arguably are more log linearized. So here now I've taken the same GDP data, and for Hawaii, segregated the nonlinear portion as a 20th century post World War II phenomenon, post demobilization phenomenon, and then separately estimated a pre-pandemic post-dot-com bubble, 20 years or so, 2-decade period, log linearly in the first part of the 21st century. And here's a close-up of the tail end of the late 20th century, conclusion of that nonlinear portion, and then this hypothetical log linear portion that I will just assert for heuristic purposes is the path that it's worth thinking about, particularly with regard to the longest expansion in US history, the expansion from the conclusion of the Great Recession in mid-2009 or maybe 2010, the outset of 2010. Hawaii was a little lag, both at the beginning and end of the Great Recession. And then this moment right before the pandemic, where I think I've actually cut this off in 2018 for reasons we'll talk about in a second. Not just because that's when population starts to turn negative in Hawaii, but that's when a number of other things seem to come into play in signaling to investors about Hawaii's future and whatnot, attitudes about resident Hawaii attitudes about tourism and so on, which we'll come back to in a second. So that's all background to get to what we want to talk about here, which is that the displacement of GDP in the post-pandemic era. So entering the 2020s, first thing that happens is the pandemic. You can see the overshoot of Hawaii GDP to the downside, the subsequent recovery, and unfortunately, the displacement, about which Brunermeyer has much to say. We'll do that in just a second. With long-term growth, if you look at the forecast of state of Hawaii DBED or you look at the forecast of the crew up at U Hero at UH Manoa, you can, you get these broadly between 1.5% and 2% real GDP growth seems to be a fair expectation given demographics and productivity growth and other considerations. Slightly below, but materially below, certainly cumulatively, the 2.1% growth trajectory that I've estimated here as kind of a stationary equilibrium for the period 2000 through 2018. And here's the close-up of that, along with an estimate of the actual trajectory, 1.6% over the 3 years, 21, 22, 23, preceding this year, which hasn't finished yet. So what we want to talk about is, why aren't we back on the original path? Like, why is that? Why don't we just bounce all the way back? And in fact, the definition of resilience is your ability to bounce back. And so one ought to be a little concerned that not only have we foregone a substantial portion of GDP, approximately 10%. I mean, just look at the scales here. These are in constant 2017 dollars in the new BEA data. Yeah, so not just 10% foregone in the initial post-pandemic recovery period, but gone forever. Like, the paths are parallel-ish, but we never get back to the old path. And as I say, there's a certain blend of art and science going on here, but there are questions raised like, why linearize in the 21st century? There's a certain arbitrariness of these dates that I've picked, like 2000 and 2018. 2018 was the peak of Hawaii expansion, partly because of the eruption of Kilauea's East Rift in May of 2018, and partly because of flooding on Kauai after the America's greatest amount of rainfall in a 24-hour period in April 2018. So, things happen. But again, resilience is about overcoming those shocks and getting back on the horse, so to speak. So Marcus Brunermeyer, in his presidential address at the American Finance Association this year, and there's a link to the YouTube video, gave an interesting talk on macrofinance and resilience. So this reproduces the beginning of Brudermeyer's presentation. You should go to YouTube and check it out. It's very accessible. He uses GDP. I'm going to use per capita GDP. So, tomato. So this is US per capita GDP, the so-called Madison data set. It's been constructed back about 400 years, continuously for about 200 years. And in 2011 dollars, the links are at the bottom of the slide. You can see how remarkably stable it was all throughout the 20th century. And what Brunermeyer is trying to draw people's attention to is that, unlike everything that came before, including the Great Depression, where the economy just got back on track in terms of per capita real GDP growth, right? After the Great Recession, the US economy did not get back on the pre-recession trajectory, which I've estimated here again in per capita terms at 2%. So it was 2% per capita terms, 2%. It's about 3/4 of that. And notice that after the COVID event, real per capita US GDP was resilient. That is, it did converge back to trend. But we still have this gap, which Brunermeyer estimates is, we're up to $4 or $5 trillion in foregone GDP as a result of never having returned to the Great Recession trajectory. And so he talks about thinking about a measure of resilience that is essentially the value of being adaptable enough to restore the pre-shock trend. right? So this measure of foregone R and R resilience measure, he defines as the value of adaptability. Had America been adaptable enough to get all the way back, we wouldn't have foregone the area you see between those two trajectories. And in per capita terms, so these are my estimates. Brunermeyer does it in total GDP and gets 4 trillion. But in per capita terms, we're looking at 5,000 constant dollars, $2017 per person, per American in 2010 to something closer to 13,000 now to something like 18,000 per person, foregone. 18,000 in constant dollar GDP foregone as a consequence of absence of adaptability. And so he goes on and check it out to talk about how we ought to think about some of this. So remember that these time series are stochastic processes. They have a drift component, a sort of trend component, if you will, and then a sort of a white noise component, if you want. And then they're also subjected to these Poisson shocks, right? These 0, 1 shocks. They're jumps with stochastic arrival times. And Brunemeyer observes, and it's true for Hawaii, that after the Great Recession, there was a displacement, the underlying GDP trajectory, real GDP trajectory, or real GDP in per capita terms, as I illustrated. Turns out for Hawaii, after the pandemic, there also was a displacement, but as we saw, not for the US. So we really want to narrow our focus now on Hawaii and ask more deeply about resilience and adaptability and whether we can think of Hawaii in the 2020s now or going forward in equilibrium, in dynamic equilibrium, if people are exiting, if right, if equilibrium is being supported in Hawaii by the fact that residents are leaving by the tens of thousands, can that be good? So again, we're going to apply some of these macrofinance type tools, dynamic macroeconomic concepts to these to the most recent of these phenomena where there was displacement of GDP after the Great Recession for both the US and Hawaii. But here we're going to concentrate on the post-pandemic displacement of Hawaii GDP from its pre-pandemic stationary equilibrium. So here's the example I want to focus on. Here's we have daily Hawaii passenger arrivals now. So, and I literally did this an hour ago. I've updated this data set through the middle of November 2024. And you can see what was going on pre-pandemic. And so go back to the moment before you heard of COVID. Was there any reason to expect that passenger arrivals from across the Pacific in Hawaii would deviate materially from the trend that I've estimated here from 2010 through something like December, I think it's 2010 to 2019. There's the trend, right? Seems like that was the escalator, right? You just get on the escalator and you get productivity growth, you download the new app and you just go. And yes, you need to manage the spillovers. You need to manage the uncompensated, unintentional, negative externalities, the spillovers from tourism and everything else, or the positive spillovers from urban agglomeration or whatever. But right, that's a management issue. Those are destination management issues. There's no reason to believe that if we were managing things correctly, tourism could have just kept on going, or at least in this case, travel, because these are tourists and residents arriving in Hawaii. And then comes the pandemic. And now I've taken the daily data, I've mapped to weekly frequencies because I want to be able to seasonally adjust the data. And once you do that, I mean, it's stunning what you can reveal. For example, the impact of the Alpha variant, the Delta variant, the Omicron variant just jump out. I mean, whatever you thought at the time of whether these variants and subvariants were material or whether you were worried about your freedom not to wear a face mask, SARS-CoV-2 virus and its variants and subvariants had material impacts on the volume of tourism, and subsequently, we've never gotten back to trend. You can see the punctuation by the Maui wildfires. Okay, that's the setup. Here's the close-up, just to highlight that this is a non-stationary regression, and then I've overlaid the stationary regression. So you're going to get 4% growth of passenger arrivals at an annual pace out of these weekly data, no matter how you look at it. And significantly, the path since the post-pandemic recovery, since vaccination, is 2% growth, not 4% growth. So incomplete resilience. All right. So now for some theory. If a process is resilient, then it should bounce back right to the initial dynamic path. So here's a path. So if you're on the path, as we were pre-pandemic, you should have, you're right, the difference is zero between where you're at and what the underlying trajectory is, on average, zero. And then if you're in a fully resilient economic situation, then whatever the source of the shock, this epsilon shock, it should take you all the way back. And the R resilience measure that Brunnermeyer commends is the present value of the area between the recovery path and zero resilience, right? If you have zero resilience, it's L-shaped. You go down, you stay down, you're done. To whatever extent you are resilient, the value of adaptability, the value of your resilience is measured by the area under that recovery trajectory, the difference between the trajectory that unfolds in a resilient situation and one that is not resilient. Okay, so that's the theory. Here's the reality for weekly passenger arrivals. Here's the theory. Here's the reality. Here's the theory. Here's the reality. Get the picture? So the problem is, and then maybe you're happy with 2% growth when 4% growth in passenger arrivals pre-pandemic was the benchmark continuously for a decade without interruption. But this way of thinking would suggest that if you are only on a 2% path when 4% was feasible, then you're at risk of being heading into what is called a negative resilience trap. That is, there is an absorbing state where the foregone benefit of adaptability, the foregone R, goes to negative infinity, right? You get farther and farther away from the trajectory leading to complete recovery. And that, I would argue, is, your problem, that not only in the pandemic itself are you foregoing adaptability benefits, but now because we're on this sliding trajectory away from the pre-pandemic equilibrium path, those foregone adaptability benefits continue to grow. So let's hang some numbers on these. DBED's been publishing monthly Hawaii visitor expenditures since 2020 to 2001, and now they've got a new tourism price index. So we'll have to, merge that with an index that's available for years in which the TPI is not available. And having done so, you can create. So this is real Hawaii or constant dollar Hawaii total visitor expenditure on a monthly basis going back to a couple decades, going back to the start of the 21st century. And I've illustrated a bunch of the different shocks. The recessions are shaded gray. So there's 2 recessions since the dot-com recession. Then you have biological events, SARS-CoV-2 and its variants. And then you have geophysical risk events, so the Northeast Japan seismic event, the flood on Kauai, and the East Rift eruption on the Big Island I mean, you can see the impacts of these exogenous shocks, and most recently, uh, uh, subverting the post-pandemic recovery, such as it was, the continuing impacts of the Maui wildfires. And so, if you take the difference between the path that I've estimated here, which is from 2002 through February of 2020, so that path, 1 to 1.5% annualized growth of constant dollar total Hawaii visitor expenditure, so real tourism receipts, on a monthly, on an annualized, seasonally adjusted basis, 1 to 1.5% growth, and the actual outcome gives you these areas, right? The integrals, right? The areas, the gaps between the path realized and the path theoretically available gives you these deviations from the path that allow you to cumulatively estimate. We'll look at three big ones: the impact of the Great Recession, full recovery from which, because of the jobless recovery, et cetera, did not occur until several years after the recession. You see that here, and then the pandemic event, which we're going to segregate from the post wildfire period, and you get three straightforward impacts of the how much we wouldn't have had to forego in real GDP in 2023 constant dollars, right? Constant 2023 dollars, 13 billion if we had had a faster recovery from the Great Recession, 30 billion if we had had a faster and more complete recovery from the pandemic, and 4 billion and counting. We're probably up to 4.5 billion now, because this is cut off in August of 2024, and it's 3 months later. So 4 going on 5 billion in foregone GDP. I'm sorry, in foregone tourism receipts as a result of the Maui wildfires. Now, how would you, what's an example of how you realize benefits of adaptability? Well, the perfect example in the case of the pandemic was implementation on October 15th, 2020, of pre-flight PCR COVID testing protocols, right? Between March and October of 2020, Hawaii had in place a 14-day quarantine requirement upon arrival. You would have to quarantine for 14 days. If you wanted to travel, that's fine. After October, the protocol: get a test within 48 hours, get a negative test within 48 hours of 2 days of departure, which time enough to pick up COVID, but uh, you're less likely to get it in the 2 days prior to takeoff than you are in the weeks prior to takeoff. And that, in addition to being effective in and of itself, represented an adaptation that had important signaling effects to the general public. That the protocol was in place, which then augmented by a vaccination about 6 months later, vaccination of the general public. Old folks got vaccines earlier, accelerated the tourism recovery. So there are things you can do. There are things you can do to adapt to the shock, and that's a perfect example. A failure of sorts is maybe what happened after the Maui wildfires, where the messaging in social media certainly was dominated by uh, uh, advocacy of not traveling to Maui, and those messages seem to have stuck. So let's get back to GDP and think about what's happened and why and where we go from here. Something happened in the late 20 teens. Something happened after 2017, and now we're looking at per capita GDP for the US and Hawaii. So per capita GDP was the same in Hawaii as it was in the US in the mid 20 teens until 2017. And then Hawaii took a right turn at Albuquerque. And now per capita GDP in Hawaii is 10% lower than per capita GDP in the US. And it's looking like it's stuck there. So that's 8,000 or 6,000, 7,000, 6,000 per person. $6,000 in constant 2017 dollars per person for all 1.5 million people. And if you in Hawaii, and if you look at the forecasts, you look at the UHERO forecast. This is the DBED forecast from third quarter of 2024. The forecast, calls for a continuation of the existing growth, slightly higher. DBED estimates 1.8%. We had estimated 1.6 a second ago, which, by the way, is the same growth path as the US pre-pandemic projected forward. So these paths look like they're stuck for now. And if you compare Hawaii based on the moment at which we turned right from Albuquerque, now we can't, this is these per capita GDP numbers. Total GDP, at the time I did this, BEA had only published the new data from 2017 onward, or 2018, the quarterly data, 2018 onward. Okay, so fine, let's go back. All time starts in first quarter 2018. How does Hawaii compare to the other 49 states in the District of Columbia? Answer is Hawaii is the worst performing state. The best performing state, Utah, has seen total GDP rise 30 percentage points since first quarter 2018, while Hawaii's GDP has risen 2 percentage points. So that's a serious gap. And as I've suggested earlier, the growth rate is also as forecast by the state of Hawaii. The growth path is also somewhat below the U.S. benchmark. If you start the calculation in fourth quarter 2019, again, Hawaii ends up the worst performing state. So whether you start at the beginning of the new data set or you start at the moment before the pandemic, Hawaii had the most trouble of any state. Nevada did too, because of tourism. But Hawaii continues to have the most problem. And in this case, the winner is not Utah, but Florida. So a pox on both of them. May the fleas of 1,000 camels infest their armpits. What we see out there is this information context now, a messaging context, a signaling context, where what Hawaii's saying to investors, what Hawaii's saying to residents, what Hawaii's saying to young residents is that we don't build telescopes in Hawaii, we dismantle telescopes. You can build a biomass energy power plant, but you can't operate it. But after you build it, you can't operate it. It's just not really positive messages for Hawaii's future, and compounded, to be fair, by a full-on disinformation. So the Lahaina wildfire in particular is now made the history books as the first event ever to have been associated with state actor disinformation operations. The first Gen AI state actor disinformation ops. So that's what's going on. And if you go back to per capita GDP over the broader historical arc, we had gone back to the 1940s, you recall, there seems to be a deeper moment in the 1970s where Hawaii really shifted gears in per capita terms now. So what we're looking at most recently is the tail end of something that has been a result of a right turn that occurred about 1975. That's kind of striking because until about 1975 was when Hawaii's per capita GDP reached its highest premium relative to the US average. So if you go back to the post-war era, right until the boomers graduated from high school, you see that per capita GDP in Hawaii relative to the US was rising from par at the end of demobilization in 1949 to a 25 to 30% premium, peaking variously between the early to mid 1970s and the late 1980s, the Japan bubble being maybe the high point. Now, a lot of us who were observing this, were concerned when the its rapid descent unfolded in the 90s. And a lot of my colleagues have reassured me over the years that, well, that was just, the Japan bubble. So don't worry about it. But you know what? 25 years later, I'm seriously worried about it because not only did it never return to the pre-Japan bubble premium, per capita GDP in Hawaii as a percent of the U.S. Was falling away from the national benchmark during the 20 teens and then decisively post-pandemic. So if you're not concerned about that, then this is not the presentation for you. Okay, GDP is aggregate output. Just as a final comment, what about personal income? What about personal consumption? Should our concern extend? So here are the personal income data for Oahu and the neighbor islands. You can see these four waves: the Catcher wave, the Japan bubble wave, the subprime bubble wave, and the most recent wave coming out of the 20 teens in per capita, constant dollar, personal income. So this is income accruing to households from all sources: wages and salaries, dividends, interest, and rent, rental income from persons, etc., transfers. And so my concern would be that post-pandemic, these personal income measures are juiced by federal fiscal stimuli, and we're actually at risk of being on a fourth arc. You can see the three preceding, the three of the last 50 years, preceding what I think is a fourth arc, which we're at risk of seeing unfold in the remainder of the 20 teens. So it could be an inverted U-shaped trajectory, such as we've seen before. Now, some things about spending. We're thinking about a lot changed after the pandemic. This is an example from credit card data. So these are Hawaii residents using their credit and debit cards relative to January of 2020. So we'll start pre-COVID, January 2020, and we'll ask what happened with spending on all retail activity. So that's the heavy black line. And you can see the initial post-pandemic decline, and then bookended by the federal fiscal stimuli, the CARES stimulus and the ARPA stimulus of March 2020 under then President Trump, and then in March 2021, 1 year later, under then President Biden, two major fiscal stimuli. Actually, there's a third stimulus in between, totaling about $5.5 trillion in infusion of support for household incomes, for businesses, and so on. And spending on non-grocery retail goods recovered, faster than retail sales as a whole, while spending on in-person services recovered much more slowly. That is, people didn't want to go to the gym, people didn't want to go to the nail salon, as long as COVID was still, evident. People didn't want to dine out initially, but spending on non-grocery retail, which is a testimony to the impact of e-commerce in the immediate pandemic shock. That is, we figured out how to make do. Some of us, worked at home. Some of us were working at home before COVID, but a lot of people figured out how to work from home. And in terms of spending, which is what we're talking about here, consumption, non-grocery retail spending shot way up above all retail, while spending on services took a while to catch up. And some of that is reflected in the growth of e-commerce, which overshot during the pandemic moment, but subsequently actually has started to drift below trend, and that's kind of a new thing to keep your eye on. Here. So e-commerce helps. We know Hawaii total personal consumption expenditure adjusted for inflation through the pandemic shock itself, and through this first year and second until through 2022, we know the path of consumption, which in per capita terms actually overshot the pre-pandemic trend, which is notable given we're looking at, GDP and tourism under pre-pandemic trend, but even total PCE looking like it was convergent on trend. My concern here is just that this may just be the impact of the stimuli. We don't have data for 2023 and 2024, unfortunately. But one thing we do have, sort of a proxy indicator, is real Hawaii General Fund tax revenues, which were growing pre-pandemic, as you'd expect, got beat down pretty hard during COVID and its initial onset and its subsequent, variant episodes, and then overshot, much like um, e-commerce, much like personal consumption and expenditure in per capita terms, adjusted for inflation in Hawaii, much like the revenge travel phenomenon for some destinations, the neighbor islands in particular, dominated by domestic travel, saw almost a full recovery in tourism in 2022. But for the last about 2 years now, these are monthly data. For about the last 2 years, constant dollar general fund revenues have been drifting downward. So you got to be concerned about that because the general excise tax, which is basically a consumption proxy, is half of the general fund. So put on your thinking caps. What are we going to do? How do we be more resilient in the long run? And what does this say about the future of Hawaii, why people are leaving, what young people have to look forward to, and what we can do to help policymakers to think about better resilience management and maybe better policymaking in general down the road. And that's the end of part 3. I'll see you in part 4. And mahalo. Thanks for your time. Aloha.